Get more with Chris Conway. He joins us from the Australian Stock Report live out of our Melbourne studio. Chris, good afternoon to you. Welcome into the program. What's your take on trade today?
I think I'll probably be more a little bit in Martin's camp that, yeah, look, there's a lot of different factors pulling in various different directions. Overarchingly, though, you know, I think most of them point to the downside. You've got a lot of things emanating out of the US, you know, what with the White House reshuffle, the ongoing tariff discussion, trade war discussion. So it seems to be, as I said, it's all emanating out of the US, and locally we're just taking our cues from what's going on over in the States. You know, not so much today. That's because, of course, the Dow in particular was down 1% overnight. We're not down anywhere near that, and our mining sector, as we've already spoken about, you guys have already spoken about, is holding the market up. But yeah, it seems we're very much a follower at the moment rather than a leader.
So how do you play it, Chris, going forward in terms of your portfolio? Because obviously we know we've got some more macro risk factors coming up. We've got the Fed meeting. Obviously a hike is pretty much priced in, so whether or not that's a risk is probably a different story. But certainly Powell's comments after that meeting could be interesting for markets. There's a lot of data points. And then on the flip side, you've got Brexit issues, Europe. I mean, there are global macro concerns to keep in mind. So how does that impact, I guess, your local portfolio, your Australian portfolio?
Yeah, so look, I would say just at first point of order, the big one is obviously the FOMC next week. As you say, Ingrid, it's pretty much already priced in, but the big debate will be around whether the dot plot shifts from 3 to 4, and you know that's been the ongoing conversation that's led to a lot of other things in the market. You know, a lot of other people positioning certain ways in the market. As to how I'm playing it locally, again, I come from the perspective of being a short to medium term trader. I haven't been particularly confident about market direction, you know, recently, and you know, and I'm so unconfident about it that, you know, I would be telling my clients to run sort of a neutral portfolio. So, you know, there will always be stocks. You know, Rudy pointed out this morning, you know, all his stocks are up today on a down day, so good for him. There will always be stocks that outperform even through periods of sideways market action and, of course, down market action. So you've got to be really selective. But overall, if you're playing market strategy, I would say there isn't a market direction at the moment. Don't try and play it. Run it neutral.
Yeah, Martin, I just want to get your view on the macro situation and how it impacts us here at home, as I was sort of getting at with Chris, because there's a lot of conflict, or, you know, I don't want to say chaos because, you know, I get in trouble for saying that too much, but in terms of saying in the White House, you know, a lot of sort of rumblings, I guess, in the White House, people being ousted, new people coming in, high turnover there. There are some concerns about how that impacts markets. Obviously, new policies coming in, yes, tax reform going through, but then you've got tariffs coming in and potential trade war. Does that impact your day-to-day sort of addings and I guess
no, I think so. Look, I think if you're going to trade, you know, the changes in the White House, you'd be manically depressed by now, right? You're bullish one day and bearish the next. I think that sort of stuff. We on this show, as much as possible, try to steer people away from that. Because you're never going to make. Chris is right. You're never going to make money doing that. You need a direction in the market to be able to make money, or you need to be, as Rudy said, in the right stock. So I think you want to avoid the noise, and you got to discern between noise and signal. But inherent in all that stuff and what's going on, we are trying to pick out what's happening to global bond rates, US bond rates. It's the single most important issue in the world is what the US 10-year bond rate is, because that really sets the asset price for everything. So I think stuff that's around that, like inflation, jobs, these sorts of things, you do need to watch those closely, because it's like joining the dots. The more dots you have, the better the picture you have. But the stuff around Trump and these sorts of things, that's just noise. You just got to separate the two, Ingrid.
So really just look at the economic data points, Rudy. You know, try to ignore what's going on in the White House, but also things like trade, tariffs and stuff. Does that impact your stock portfolio?
I was about to say, I agree with everything that Martin just said, except the fact that it's now all about the 10-year yield. I think the momentum now has shifted the market's attention to what potentially could come out of the White House that's negative for global growth. And if it's negative for global growth, it will be negative for all the rest. And I think what we've seen in the past weeks is that the market's attention has shifted towards what could be the darker side of a populist policy in the White House.
So we'll watch that closely and see how...
That just gives us uncertainty.
Yeah, uncertainty, I guess, with policy, because policy is actually getting through under Donald Trump. That's something you've got to keep in mind. So it does actually make an impact on markets or economies.
It's also that what we probably underestimate is that the world really has become a two-speed world, where on the one hand, the US is the old giant, and it used to be the engine for global growth, but in modern times, China is as important, if not more important, than the US is, because of its influence on the rest of Asia, So if that's the battle we're going to see, then we really have a little bit of trouble in the world. I mean, and that's why the market is very uncomfortable about it.
Speaking of China, we had some really positive data, industrial production in particular, out of China yesterday. That's obviously played out on commodities overnight. We did see commodities bounce, iron ore, you know, I guess ending this 8-day losing streak. We've seen oil up a bit as well. Chris, how does this impact your holdings? I know you've been adding to BHP recently. Is this a trade you'd still be doing, or have you finished adding to your position there?
Look, I'm only a one-shot player, so once I give my clients advice to buy something, they're in it, and away we go with the trade.
Yep.
What I would say, though, is that, you know, BHP sub 30 is worth looking at. I think there's still pretty good demand out there for metallurgical coal and indeed quality iron ore, you know, the higher percentage fines. And of course, BHP stands to, you know, reap a windfall if they can successfully sell their shale oil assets. I think it's Shell and Blackstone poking around at the moment to the tune of about $10 billion. Once they take out all the fees, it'll be a bit less than that. But yeah, there's some upside catalysts there for BHP. The commodity stories for us remain strong. And then it's just about buying it on a pullback, buying it on a price sub 30 if you can get it.
What do you think, Martin? Because I know you've been bullish on BHP and the miners. You still stand there, Martin?
Yeah, very much so. And you know, I think that's sub 30 bucks. I mean, Peter O'Connor, my colleague at Shaw and Partners, has called this pretty well, and he talks about fresh high lows. We are 26 or 27 months now into the resources bull market, so it's been going for a while now. They typically go, you know, 3 to 5 years. So we're sort of getting towards, you know, the bottom end of a traditional, you know, trend. But you know, the ebbs and flows in the Chinese fixed asset investment, the ebbs and flows in iron ore, coal, what's happening with the sale of shale, all those things in the mix suggest that the outlook's probably a little bit better. But we are probably in a little bit of a consolidation phase now before we sort of push on. And we think ultimately the stock's going to 40 bucks. That's at kind of our top of the cycle sort of range.
Is there a timeline for that?
You know, I wish we could pick the date, because it would make my life and everyone's life a little bit easier. But you know, we're on our way there, we think, in terms of earnings and both the rating of the market. So that really is when inflation's out of the bottle and the Fed's starting to have to rake a bit more, hike a bit more aggressively. That's when people will be chasing commodity stocks. So that at that point, that's probably later this year, early next year is kind of when that happens.
Speaking of commodities, and BHP obviously well exposed to oil, Rudy, what's your take on oil going forward and oil exposed stocks here in Australia?
I can summarize that very simply: sideways forever and ever. And yes, it's volatile on a weekly basis and it moves, I know. But you know what? If you take a longer-term view and you take a longer-term view forward, I think it's sideways is the way for oil.
All right, so it's a tough commodity pick out of a lot of them, I must say.
No,
oil.
It's not. It just goes sideways.
Chris, do you agree with Rudy that he's very strong on the fact he's got a lot of conviction on oil moving sideways?
I was hoping you wouldn't come to me next, Ingrid. Rudy and I often butt heads on this one. Rudy, you'll forgive me for pointing out that you were wrong at 50, wrong at 55, wrong at 60 and wrong at 65. I'm certainly more bullish. I think the underlying fundamentals are supportive. You've got a global growth environment where demand is picking up, and you've got obviously the supply side restrictions that we all know about. The Saudis are agitating for further production cuts to extend out to 2019, and let's not forget that they're listing 5% of Saudi Aramco sometime this year, which they will want to maintain a strong price for so that they can achieve a good sale price. So maybe I'll be wrong this time around, but I think there's further upside.
Yeah, okay. Martin, are you the mediator between these two?
No, Martin's positive.
Yeah, no, look,
You're a lone wolf, Rudy.
I think the word we use is constructive. We're constructed towards oil. So, look, there is a view amongst people that have been in the oil business for a long time that US $70 a barrel is around about the replacement cost. So that's how much it costs to you know, find it and get it out of the ground and all that sort of stuff. So that's kind of the equilibrium price. So the issues the guys are talking about, whether it's OPEC or it's shale or whatever, those things will ebb and flow, but it'll probably average around somewhere around $70. So at the moment, it's a fair bit below that, so it's probably got a bit of upside in it.
All right, well, we've got to talk A2 milk because we always talk A2 milk. It's been one that just continues its uptrend. There's a lot of questions around valuation at this level, whether or not, you know, maybe you should stop adding to positions, take a bit of profit. Chris, you're still buying it?
Still buying it. Another one that's probably to get some pushback from certain people on the panel, but I'll have a crack at it anyway. Look, I still think it's a buy. It's an amazing growth story. They're expanding into the US and the UK further, and there's still growth to come in China. So look, as analysts, everything that we're trying to do is trying to predict the future. And whether you look at the price action from the stock or whether you look at this management's track record of being able to expand what has proven to be a product that consumers want, they're managing to do it, exceptionally well. There'll be some people that might point to the PE being up around 47 times. You know, in a growth stock where EPS growth in 2018 is likely to be 125%, what do you expect the PE to be? You've got to expect a high PE for a company that is growing at the rate that it is. So yeah, I'm still a buyer of this one and have been since about $8. So it's rewarded me thus far.
Completely different stocks. I don't want to compare them, but CSL and A2 Milk are two that come up as continual outperformers despite a rich valuation, Martin. Obviously very different stories, very different growth prospects, but A2 Milk, are you a buyer at these levels?
Yeah, look, we don't cover it in Shaw and Partners, so you know, my sort of comments are more around, you know, what the market thinks and what the market says. And you know, as Chris said, it's on 50 times this year's numbers and about 35 next year. But inherent in that is an underlying growth, you know, profile of 25 to 30%. So, and a massive addressable market. So if they can continue to sort of expand their market share of what is a massive addressable market, then they'll continue to show growth. Having said that, there's, with all these things, they're really agricultural stocks at the end of the day, and there's inherent risk with agricultural commodities, whether it's milk or nuts or anything else, right? So I think you kind of have to factor a little bit that in. It's had a huge run. You're tempted to sort of look at it and go, it's probably going to need to consolidate, and maybe that PE at 35 is kind of as full as it gets in the shorter term, so maybe it has a bit of a breather. I know it's caught a lot of people short because it's gone into the ASX 100. It's gone out of the small ordinaries, and a lot of people held it in small cap funds. Big cap funds really don't own it, so I think the market's underweight the stock, if I can use that language. So that means there's probably people buying it not because they want to, but because they have to.
Fits into the different funds.
Yeah, so that's probably keeping it at these sort of elevated levels. So look, it might be one where it just doesn't do anything for 6 months and it just gets cheaper by the fact that the bottom line's growing by 25 to 30%.
Rudy, I'm interested because a few of the guests we've had on have said, look, you know, it's a great stock, the result was amazing, but going forward there could be some regulatory issues coming out of China. There's some changing in packaging and things like that coming into China over the next sort of 12 months. I mean, could this impact A2 Milk, do you think, in a negative way?
But A2 Milk less than competitors like Bellamy's. And you've seen that in the past. I mean, I never tire to point out that if you observe those stocks for long enough, you see how the quality distinguishes itself from the rest. And we've seen over the past 12 months, or longer basically, that A2 Milk is above the rest in terms of management quality and the company itself. The reason why people are skeptical is because they look at the share price, they go like, oh, it has run so hard, but they underestimate what it can do to the valuation. And I note, for example, that the brokers who are now covering the stock are basically putting share price targets which are well above today's share price.
All right, so it's a buy, really, consensus.
Exactly.
All right, well, there you have it. Chris Conway, we will leave it there with you, but always appreciate your analysis. Thank you for joining us.
Thanks, guys. Cheers. Have a good day.
All right, we'll